Have you ever noticed how money doesn't just buy things, it controls how you feel? When neuroscientists put people in brain scanners and simply showed them images of money, the same regions lit up as fear, survival, and reward. The brain treats money like oxygen. Losing it triggers pain signals stronger than physical discomfort, while gaining it barely registers by comparison. This is why losing $100 hurts far more than finding $100 feels good. And this imbalance isn't accidental. It's the psychological foundation that modern financial systems quietly build on. But once you understand how your brain reacts to money, a more uncomfortable question appears. What happens when someone learns how to control those reactions at scale? Most people think they're rational with money, but psychology says otherwise. Money anxiety affects over 70% of Americans, regardless of income. Rich or poor, the stress is the same, because money isn't just currency. It's identity, status, safety, and belonging. Psychologists call this loss aversion. Humans will take extreme risks to avoid losing what they already have, even if it harms them long term. This is why people stay in bad jobs, accept unfair fees, or tolerate broken systems, because stability feels safer than change. And this fear becomes far more powerful once money stops being something you can physically hold. Here's where something subtle and dangerous begins to happen. When researchers compared people paying with cash versus cards, they found something shocking. People consistently spend more when they can't physically feel money leaving their hands. The pain of paying disappears. Digital money doesn't register as real loss in the brain. Swiping a card feels abstract, like a game score changing, not survival resources being depleted. And once money becomes abstract, controlling how people use it becomes far easier. This is the moment where the system quietly changes sides. Cash is simple. It moves directly between people, instantly, privately, with no third party taking a cut. A $100 bill can circulate 20 or 30 times through an economy without losing a single dollar of value. But digital money doesn't move freely. It passes through gates, and every gate takes a fee. What looks like convenience on the surface hides something much deeper underneath. Let's talk about the fee nobody sees, but everyone pays. In the United States, every card swipe costs merchants roughly 1 to 3%. That sounds small until you realize those fees added up to $148 billion in a single year. That money doesn't disappear. It concentrates upward into banks and payment networks. And merchants don't absorb those costs, they pass them to you through higher prices. So the real question isn't, do you pay card fees? It's how many times are you paying them without noticing? Now imagine the same $100 moving digitally instead of physically. If that money is spent 20 times with a 1.5% fee each time, over a quarter of its value is silently extracted. The original $100 becomes roughly $74. Not because of inflation, not because of waste, but because toll booths were built into the system itself. And the deeper that money travels into the digital economy, the thinner it becomes. This is why banks aggressively push digital payments, even when customers prefer cash. Handling cash costs banks money. Digital money makes them money. Every digital transaction generates fees, interest opportunities, and data. Every dollar sitting in your account becomes leverage they can lend, trade, or invest. And every purchase you make creates behavioral data. What you buy, when you buy, where you go, and who you're with. Which leads to the next uncomfortable realization. Money is no longer just currency, it's surveillance. Cash doesn't report you. It doesn't create metadata. It doesn't care what you buy, where you buy it, or how often. That's why economists and privacy experts consistently warn that cash is the last truly anonymous financial tool. Once it disappears, financial privacy disappears with it. And that's not a hypothetical future. It's already happening. Across the world, governments are actively preparing for life after cash. Over 130 central banks are researching or piloting central bank digital currencies. Government-issued digital money. These systems promise speed, efficiency, and inclusion. But they also introduce something cash never had: programmability. and programmable money changes everything. With programmable money, spending rules can be written directly into currency. We already see this in basic form today. In the US, food assistance cards can't be used for alcohol, cigarettes, or cash withdrawals. That's not a theory, but it's real policy. The system decides what you're allowed to buy. Now, scale that idea to an entire population. Imagine money that expires if you don't spend it fast enough. Imagine stimulus payments that only work on approved items. Imagine certain purchases blocked automatically based on behavior, location, or compliance. These ideas aren't science fiction. Policymakers openly discuss them as tools for economic efficiency and behavioral nudging. But the moment money can be programmed, it can also be restricted. And once restrictions exist, enforcement becomes automatic. No police, no court order, no explanation. The transaction simply fails. We've already seen early versions of this during protests, emergencies, and financial freezes. Accounts locked, payments declined, access removed, and in a cashless system, there is no backup plan. Supporters argue the benefits are worth it. They say digital money fights crime, improves tax collection, speeds up payments, and helps the unbanked. Some of these claims are true. Digital systems are efficient, they are powerful, but power always concentrates, and efficiency never comes for free. The real issue isn't technology, it's incentives. Banks want digital money because it centralizes control. Governments want it because it increases visibility and compliance. Payment companies want it because it locks users into ecosystems. None of these incentives are aligned with individual autonomy. And history shows that systems built for control rarely stay limited. This is why public resistance is growing. Countries like Switzerland have held national votes to protect cash. US states have moved to restrict or ban central bank digital currencies. Surveys show most Americans do not want a cashless society. People instinctively understand something important is at stake, even if they can't fully articulate it yet. And that instinct matters, because money is not neutral. It shapes behavior. It defines freedom. It determines who has power and who doesn't. A fully digital system could be convenient, fast, and efficient, but it would also be the most controllable financial structure in human history. And once built, it won't be easy to undo. So the real question isn't whether cashless systems are coming, they already are. The question is what rules they'll be built with and who gets to decide them. Will money remain a tool you control, or will it become a system that controls you? That answer depends on what people understand and what they're willing to accept right now. Because the future of money isn't just about payments, it's about power.